Uber has released the details for its stock market debut. The ride-hailing service will sell 180 million shares at a price range of between $44 and $50 US. And while that translates into a total valuation for the company of about $84 billion, it's actually about $10 billion less than its previous target. Santosh Rao, head of research at Manhattan Venture Partners, joins us now to weigh in. Santosh, good to catch up with you today. Thank you very much for your time.
Thank you. Thanks for having me.
Let's lay this out for our viewers, just in case they're just catching up to speed in terms of what the details are here. They're raising $9 billion. The company is going to be valued at $84 billion. How are you looking at the valuation in this offering?
Yeah. So the valuation at this point is very reasonable, at 7 times sales to 9 times sales, depending on where you go in the range. But I think it's reasonable at this point. But going by the past IPOs, I'm sure there is going to be demand. It's going to be booked solid. So I think the demand, it's going to raise the price. In the past, we've seen prices go up at least 10 to 15% from the original range. So I wouldn't be surprised if it goes up a little more. But anything less than 100 billion overall on a fully diluted basis is still reasonable, especially given that 120 was overvalued. And given Lyft's experience, I think it'll be well received anywhere between 90 to 100 billion.
So, Santosh, let's talk about the valuation then and what this company really is. There's some very interesting value-oriented investors who do not believe the valuation of this company whatsoever. They think that there's too much marketing hype around it, and it's really just a car service company. So why is a car service company worth $100 billion?
Yeah, so this is definitely not a stock for value investors. It does not fall into their area. This is a growth stock. This is for growth investors who are willing to bet that the future is going to be transformational. People are going to rent versus buying. On-demand services is going to be big. The people are not going to buy their second car. So just the demand, the transportation market, the consumer transportation market is close to 1.2 trillion. So even if you take off a little bit, it's a big number. So these two companies, Lyft and Uber, are going to disrupt that. People like it. There's a demand from the bottom, from ground up. So you have to bet on a future. It's not visible at this point. It's coming in increments. It's slowly. But for value investors, you have to wait. Profits are way up in the future, way down the future, rather. It's all about the top line and how they manage their expenses at this point. So if you look at that metrics, the revenues are growing fine, and the operating metrics they're controlling, but they still need to be controlled more.
So the company loses money. The cost to acquire a new user is increasing. The cost to acquire a new user is increasing. Doesn't that tell us that maybe it's a little bit more mature or there's more competition? In other words, is it really worth $100 billion?
No, not really. I mean, at this point, they are investing. They're still making the market. The penetration rate of these services is still very low. There's a huge market out there in the US and maybe North America. Only about 15% of the people, of the families that can use this thing have actually used it or know about it. So it's a long way to go. And so you're going to say the market is there. So it's going to take a while for that to develop. At this point, they are investing. Yes, the driver incentives and the rider incentives are eating into the profits or increasing the losses. But down the road, as Lyft said on its roadshow, and Uber will probably emphasize also, they are going to rationalize their costs down the road. The incentives are going to be more targeted for drivers and for riders, so they can rationalize the take rates and the operating expenses down the road, which is not too far. I mean, as a public company, they will be pressured to move fast. So in 2 or 3 years, you'll see a much better financial picture. But at this point, people need to focus on the top line and the take rates. As long as that's growing in the right direction, they should be okay with that.
What do you think then is the right top line growth number to hang your hat on?
Well, at this point, I mean, Lyft is growing at a very good clip. The bookings are growing at more than 60%. So I would say focus more on, I would say they're different. Okay, to start with, Uber and Lyft have different models. So Lyft is a pure play with a defined path to profitability. Uber is slightly different. It's feeling the pressure of Uber Eats, even though that's big, it's cutting into the margins. So they're different models. So if you want a platform play, you go into Uber. If you want a pure play ride hailing, you go into Lyft. So I would say anything above 40 to 50% top line growth on the gross booking side, 20 to 30% on the revenue side, but with controlled operating expenses moving in the right directions, with sales and marketing, insurance costs coming down. These are costs that can be controlled. At this point, they're spending a lot to get the drivers in the network and keep them happy. But down the road, they will have some operating leverage as they get critical mass down the road. So I think you'll get some rationalization of the model down the road. At this point, stay focused on the revenue that's growing and losses coming down.
Santosh, with respect to the roadshow that began today, hard to believe it. My goodness, it started today. They're going to see 9 cities in North America over the next week or so, and then obviously price the deal. What do you think company management and the investment bankers are going to be saying as it relates to this story? What's the theme? One of the takeaways, of course, is that they're more than just a car service. So what will we be thinking about as it relates to Uber as more of a car service?
Yes. Yeah, Uber is going to emphasize the fact that they are a global play. They're essentially a proxy for the state of ride-hailing business all over the world. They have a stake in China. They have a stake they have a running independently in India. They just bought Careem in Middle East and Southeast Asia. So they are in all the high-growth markets. But U.S. is where the real action is. This is where the revenue is. Revenue per ride is the maximum here in the U.S. So they need to show growth here. So they are diversified. They have to be careful saying that we are a global player. That's not necessarily a big advantage, because in this business it's very localized. The incumbents in every country are pretty strong, and they will have to spend a lot so to really gain market share, and that's what they're doing in India and other places. They're spending a lot. So just because they have size doesn't automatically translate, but what they can emphasize is that we have a number of levers to pull. We have the Uber Eats and the freight and the drones down the road and the ride-hailing business. So that's what they're going to emphasize. They're going to separate themselves from Lyft, saying that they're very focused on one side. We have more. So we are a platform, like the CEO says, we are the Amazon of ride-hailing business. So I think that's what they want to be.
I wanted just us to take a look at the shares of Lyft, because they are dramatically lower than where they priced their IPO. They priced it at $72. Let's bring up Lyft shares for our viewers to see. Santosh, what do you think is going to be the story, and how does a management communicate the right story and therefore the right pricing range to any institutional investor who bought into the Lyft IPO and was so disappointed to lose $20 off the mark? How do you differentiate yourself? I mean, you're still in a similar company, same industry.
Yes. Let me just say that, Lyft IPO process did not go very well. As far as the company goes and the bankers go, they did well. The company got their money. The bankers got whatever deal they were trying, and they got money for the company. So they're happy, but the investors got hurt. I always thought, and we initiated coverage way before, and we have our clients in way before the IPO. We do pre-IPO shares as well. So we felt that the right price was in the 60 to 65 range. I wish they had stuck to that range. But even now, at this point, closer to $60. I mean, it's between 57 to 60 on a forward basis. It's 3 to 4 times sales. It's very compelling. The risk reward at this point is very compelling. You're going to see some pressure because of Uber coming in. Maybe some investors go in and out, but in the end, it's a duopoly. There is a place for both of them. They're going to survive. So at 3 to 4 times forward sales for Lyft, at 5 to 6 times for Uber, I think both will be very well priced. You can hang your hat there and wait for the company to execute.
Okay, Santosh, great to catch up with you. Thank you for your perspectives.